This week, the RBA minutes revealed they hiked rates because housing credit and prices are picking up again. And at the same time, the new HIA planning scorecard says we now need to build around 260,000 homes a year to hit the government's $1.2 million homes target. Last year, we only delivered 173,000. So let's unpack what that clash between policy and reality means for prices, rents, and your next move as an investor. So none of this is guesswork. This update is based on the RBA's February meeting minutes released and analyzed this week, which explain why they lifted the cash rate to 3.85% and what they're seeing in credit and housing. The HIA 2026 Planning Blueprint Scorecard released on the 17th of February, plus coverage from realestate.com.au, as well as Architecture, spelling out how far behind we are on the 1.2 million homes target. And we've got fresh domain auction results for the week of 14th February showing how buyers are actually behaving on the ground. So most of the headlines will talk about rates being up or more planning reform is needed in isolation. Here, everything is stitched together so you can see the cause and effect through an investor lens. So stay with us on this one because in the middle of the video, there are key moments where we'll actually line three things together. The RBA's concern that housing credit and prices are reaccelerating, HIA's new estimate that we now need roughly 260,000 new homes per year to get back on track, and this week's auction results that show demand is still holding up in most capitals. Once those three are on screen together, it becomes pretty obvious why the RBA is leaning on rates to cool demand, why planning systems are still choking supply, and why that mix keeps supporting prices and rents in the right suburbs. So let's start with the demand side, credit and options. Then we'll hit supply, policy, and we'll bring it all together at the end. So on 16th of February, coverage of the RBA minutes made it very, very clear why they hiked the cash rate by 0.25% to 3.85% earlier this month. But the key points for the minutes and analysis says the board judged that risks around inflation had shifted materially, and without action, inflation would likely stay above the 2.2 to 3% target band for too long. And members discussed the option of doing nothing, but ultimately they unanimously chose a hike because recent data had surprised on the upside. They highlighted that demand is now clearly exceeding supply in the economy and that tight labor markets and elevated labor costs are adding to price pressures. So crucially for property, the minutes are supporting commentary saying housing credit growth has picked up notably, now growing faster than household incomes. And that is being driven by a pickup in investor credit. House prices and mortgage lending had accelerated, and the board noted that financial conditions had eased materially despite earlier cuts. In other words, markets and borrowers were behaving as if rates were lower than the RBA wanted. So the February hike wasn't random. From the RBA's view, they were watching strong inflation, stronger credit growth, and stronger housing activity, and decided policy was no longer restrictive enough. So in the short term, what that means is that borrowers on variable rates are absorbing another hit. Fixed rate offers are likely to drift a bit higher, and the RBA is now in data-dependent mode with no preset path. They're not promising cuts any time soon. So medium term, it reinforces a pattern. Every time housing and credit heat up too much, the RBA is willing to tap the brakes, even if that hurts new building. Now, how is that showing up at the coalface, at the auctions? So looking at Domain's latest auction update for Sunday 8th of February to Saturday 14th of February, it paints a fairly resilient picture. For that week, Sydney is at 60% clearance rates off 1,024 auctions scheduled. Melbourne is at 64% clearance rates with 832 auctions scheduled. Brisbane's at 58% with 149 auctions. Canberra at 65% with 96 auctions, and Adelaide with a clearance in the mid-60s with volumes building into the peak selling season. So all this in plain English, anything that is consistently above 60 to 65% to a fairly balanced and slightly rising price environments. In the high 60s in Sydney and mid-60s in Canberra and Adelaide are not signs of a market falling apart. They're signs of enough buyers and not enough good stock. So the short-term implications here is despite the February rate hike, early year auctions are holding up. Vendors are still getting deals done, reasonable clearance levels, and the pain is more likely sitting with marginal borrowers and highly leveraged households, not with the entire buyer pool. So in the medium term, if we see clearance rates stay in the 60s while supply remains constrained, it suggests slow upward pressure on prices rather than a sharp correction, especially in quality, family-friendly stock. Now let's move from the demand side to what changed this week on the supply and policy side. And this is the big supply story of the week. On 17th of February, the Housing Industry Association, HIA, released its 2026 Planning Blueprint Scorecard, auditing every state's planning system against the federal government's National Planning Reform Blueprint. So a couple of headlines here. In the 2024-2025 financial year, Australia delivered 173,232 dwellings under the National Housing Accord to hit 1.2 million homes between mid-2024 and mid-2029. We need about 240,000 completions per year. So HIA's analysis here, echoed by realestate.com.au as well, says that means last year we fell at around 66,768 homes short of the annual target. And we now need to deliver roughly 260,000 homes per year for the next 4 years just to catch up. So HIA's verdict, no jurisdiction has scored greater than 3 out of 5 on the planning reforms. There is a critical disconnect between the housing supply goals of National Cabinet and the ground level reality of local government delays and restrictive zoning. And state by state, the scorecard and this week's coverage say WA and South Australia, they're tied at first place on 3 out of 5. They're actually praised for large-scale rezonings, land releases, streamlined approvals, and digital planning systems. Victoria and ACT sit around 2.5 out of 5. So they have some reforms, so they're missing middle, low-rise codes, streamlined single-dwelling approvals, but still bogged down in other areas. New South Wales and Tasmania are at 2 out of 5 points, with ambitious plans like transfer-oriented development in New South Wales, but it's not yet clear they'll translate to actual supply at scale. Queensland and Northern Territory is 1.5 points out of 5, which are the lowest scores out of the other states, with systems described as business as usual and not keeping pace with demand. So HIA's message here is until planning and approvals genuinely speed up, talking about 1.2 million homes is just that. It's just talk. From granny flats to high rises, Australia needs more shovel-ready land and faster assessments, not just schemes and slogans. So the short-term implication, builders and developers remain constrained by planning, not just the interest rates. Even if buyer demand cooled a little bit, there's still no sign yet of a flood of new stock coming to a balanced market. In the medium term, if Australia continues to run well below the 240,000-260,000 completions per year, the structural shortage worsens. That supports rents and prices in most well-located areas, even if interest rates stay high for longer. Now, combine that with what the RBA just said. They think demand is strong, and at the same time, planning is holding supply back. That's where the tension really bites. So there are a few subtle sentiment shifts this week. Coverage of the RBA minutes leans heavily on the idea that rates could stay higher for longer, and that further hikes are possible if inflation doesn't cool as hoped. Industry commentary on the HIA scorecard talks about a growing divide between reform states like WA and SA and laggards like Queensland and Northern Territory, with calls for a national dashboard to expose planning days. And the emerging narrative is this: investors and builders are increasingly skeptical that the 1.2 million homes target will be met under current planning systems. Markets are adjusting expectations towards higher for longer interest rates, but not necessarily lower prices, because supply is clearly not ramping fast enough. So the risk shifts from will there be a crash to how long can this combination of tight supply, high rents, and higher borrowing costs run before something gives, either in policy or in parts of the market. That sets up the convergence moment. When you layer this week's pieces together, a clear picture comes out. Firstly, the RBA's view. Credit and housing activity have picked up, driven especially by investors. Inflation is still too high, and demand exceeds supply in the economy. The board now sees inflation risks as having shifted materially, so they're comfortable hiking to 3.85% and keeping options open for more. Two, the HIA's view. Actual completions last year, 173,000 homes, which is well short of the 240,000 per year implied by the Accord. To get back on track after that shortfall, Australia would now need around 260,000 new homes per year for the rest of the Accord period, something we've never done before. No state scores are above 3 out of 5 on planning reform. So planning remains a key bottleneck here. And thirdly, market behavior. Auction clearance rates are still in the mid-60s to high 60s across major capitals. That says that buyers are still there. There's no sign this week of data on a demand collapse. More a case of buyers being a bit more selective, but it's still turning up. The aha moment here is that Australia is running a tight supply. Higher rates, still active demand in the housing market. The RBA is trying to cool the demand side with rate hikes, while planning and approvals are failing to deliver the supply side needed to take pressure off prices and rents. For investors, this has two big implications. Well-located family-sized stock in markets, half-decent planning, so think parts of WA, SA, some infill sites in New South Wales and Victoria, is likely to stay competitively bid, even if borrowing capacity is a bit lower. Higher leverage plays that rely on fast capital gains in areas with weak planning performance, low yields, and stretched buyers carry more risk if the RBA ends up hiking again or staying higher for longer. So the game is less about timing the next rate move and more about understanding this structural tension between policy and planning supports some parts of the market and leaves others exposed. So to reduce the noise for you, here's what didn't move in the last 7 days. The headline price data. We don't actually have new monthly core logical totality or PropTrack home value index released this week. January's 0.8% national rise is still the latest full-month figure, so there's no fresh evidence yet of a post-hike price wobble, just the same gentle upward slope we saw a fortnight ago. Rental vacancy, we don't have new SQM-based vacancy prints this week. January's 1.2% national vacancy rate is still the latest, pointing to a very tight rental market. And that underlying rental squeeze hasn't eased. We're just waiting on February's data to confirm whether it tightens again. And migration and population settings. There are no major migration policy changes or new ABS population releases this week. The medium-term story of strong demand growth colliding with slow new supply is still unchanged. So why does this stability matter? Because it tells you this week's developments, so RBA minutes, planning scorecard, and options are adding to an existing pattern, not reversing it. The pressure cooker settings, which is high demand versus constrained supply, are still on. The dial has just been turned a little higher. So looking ahead, here are the key signals worth keeping an eye on. Any early signs of auction fatigue. So watch the next domain or core logic auction wrap up. Do clearance rates hold in the mid-60s and above, or do they slip as more stock comes on and buyers digest the rate hike? 2, follow the commentary on the HIA scorecard. Expect more pieces breaking down what specific reforms WA and SA are doing that others aren't, and whether the federal government responds with carrots or sticks for the laggard states. And 3rd, market reaction to RBA minutes and data prints. If upcoming inflation or employment data comes in hot again, watch how quickly talk shifts from one and done hike to maybe another move. That will feed straight into fixed rate offers and borrowing capacity calculators at the banks. And lastly, any pre-budget housing leaks. With the Accord clearly off track on supply, look for any early hits of additional planning incentive payments to states or new investor-focused tax or lending changes framed as affordability measures. Now, if this helps you cut through the noise and actually understand what this week's RBA minutes, auction results and planning scorecard mean for the market? Tap like. It tells you to show this to more Aussies who care about data, not just the headlines. If you want a clear, no nonsense wrap like this every week, make sure you hit the subscribe and turn on the bell so you don't miss the next update. And look, if you're listening to all this and thinking, okay, I get the rates, planning, and auctions are pulling in different directions, but still don't know what that means for my next purchase, my borrowing, and my risk, that's exactly where Investor can help. Right now, a smart strategy has to assume rates could stay high for longer than most people hope. Planning systems don't suddenly unlock 260,000 homes a year, and rents and prices in the right pockets keep feeling the squeeze. On a 20 to 30-minute strategy call, you can map your current position, income, equity, borrowing power against this higher rate, low supply reality, stress test your portfolio for the next deal for another 25 to 30 basis points of risk, and slow new building. Get clear on which markets and property types are most likely to benefit from the ongoing supply crunch and which are most exposed if sentiment turns. No hype, no buy now or miss out game. Just a calm, numbers-driven chat that makes sure you're not making 6 or 7-figure decisions off half-understood headlines. If that sounds useful, hit the link in the description, book a time, and get some clarity around how to invest with the current settings instead of fighting them, because the RBA will keep moving. Planning will stay political, but your strategy doesn't have to be reactive. Thank you for watching. See you next time.